Welcome to Hashbeaks Finance. Today we are going to be looking at John Bogle's 10 Rules for Investment Success. John Bogle, as many of you know, was the founder of Vanguard, a pioneer of index funds, and a true legend in the investing world. His advice is timeless, and his rules are surprisingly simple, yet incredibly powerful. So if you're ready to learn from one of the greatest investors of all time, let's get started. In the world of investing, it's so easy to get caught up in the excitement of chasing the next hot stock or trying to time the market perfectly. But Bogle reminds us that the real key to success lies in understanding the fundamental principles that drive long term growth. And one of the most important of these principles is this idea of reversion to the mean. Now, this might sound a bit technical, but it's actually a pretty simple concept. What goes up must come down. Well, this is especially true in the financial markets. Think about it. You've probably seen those charts of market performance that look like roller coasters, with those dramatic peaks and valleys. That's reversion to the mean in action. Bogle emphasizes that the past performance of a fund doesn't guarantee future returns. It's like trying to predict the weather based on last year's forecast. We just can't do it reliably. Bogle actually did a fascinating analysis of 8 of the most successful mutual funds, charting their performance against the S&P 500 index over several decades. And guess what? Every single fund, even the ones that had initially soared high above the market average, eventually reverted to the mean. They all experienced periods of decline, sometimes pretty sharp declines, bringing them back down to earth. So, what's the lesson here? Don't get seduced by short term performance. Just because a fund has had a stellar run in the past doesn't mean it'll continue to outperform forever. Remember, what goes up must come down, and those who ignore this fundamental principle often end up disappointed, if not worse. Bogle's second rule builds on this idea of resisting the urge to chase short term gains. He says, time is your friend, impulse is your enemy. This is where the real magic of investing comes in the power of compounding. Now, you've probably heard this term before, but it's worth really understanding how it works because compounding is what allows your investments to grow exponentially over time. Think of it like a snowball rolling downhill. It starts small, but as it rolls, it gathers more snow, becoming bigger and bigger over time. That's the beauty of compounding. The longer you let your investments grow, the more those returns snowball, creating a truly impressive wealth building machine. But here's the catch. Your biggest enemy in this process is your own impulse. We humans are emotional creatures, and those emotions often lead us to make bad decisions, especially when it comes to money. When the market is booming and everyone seems to be getting rich, we get greedy and want to jump in, often buying at the top of the market just before things start to turn south. Then, when the market inevitably takes a dip, fear sets in and we panic, selling our investments at a loss, often locking in those losses right at the bottom of the market. Bogle recognized this human tendency, and that's why he stresses the importance of staying disciplined, of not letting your emotions dictate your investment decisions. Instead of reacting impulsively, he urges us to view market downturns as opportunities. When fear drives others to sell low, that's your chance to buy low, potentially scooping up some bargains that will pay off handsomely in the long run. Now let's talk about Bogle's third rule, which goes hand in hand with this idea of patience and long term thinking. Buy right and hold tight. So, what does buy right mean? For Bogle, it's all about diversification. Don't put all your eggs in one basket. Instead, spread your investments across a wide range of assets to reduce your overall risk. And one of the best ways to achieve this diversification is through index funds, which, as you know, Bogle was a huge proponent of. An index fund essentially allows you to own a piece of the entire market rather than trying to pick individual stock winners. It's like owning a slice of the whole pie instead of betting on just one piece. This approach takes the guesswork out of investing. You don't need to try to outsmart the market or predict which companies will be the next Apple or Amazon. You simply capture the overall growth of the market, which over the long term is consistently trended upward. The whole tight part of this rule emphasizes the importance of patience and discipline. Stay the course through market ups and downs. Remember, time is your friend. You might be tempted to take on more risk than you can handle, or fall prey to scams and schemes that promise you the moon but deliver nothing but heartache. So remember, slow and steady wins the race, especially in investing. Now let's talk about Bogle's fifth rule, which he cleverly illustrates with a memorable analogy. Forget the needle, buy the haystack. What he's talking about here is the common mistake of trying to pick individual stock winners, which he compares to finding a needle in a haystack. It's incredibly difficult, time consuming, and often futile. Think about it. Even professional stock pickers, with all their resources and expertise, struggle to consistently outperform the market. And for the average investor, trying to pick winning stocks is often like trying to win the lottery. The odds are stacked against you. Instead of wasting your time and energy trying to find that elusive needle, Bogle suggests focusing on owning the entire haystack, the whole market, through those wonderful index funds we talked about earlier. This way, you capture the overall growth of the market without having to worry about picking individual winners and losers. It's a simple, effective, and remarkably powerful approach. And that brings us to Bogle's sixth rule, which focuses on something that many investors overlook or underestimate: minimize the croupier's take. Now, you might be wondering, what does a croupier have to do with investing? Well, Bogle uses this term to refer to the fees and expenses associated with investing. You see, just like the croupier in a casino takes a cut of every bet you make, financial institutions take a cut of your investments through various fees and expenses. These costs, even if seemingly small, can significantly eat away at your returns over time. Imagine you're at a casino playing a game where the house takes a small percentage of every bet you make. Over time, even if you win some hands, the cost to take by the house can add up and really chip away at your winnings. The same principle applies to investing. Those seemingly insignificant fees and expenses can have a huge impact on your returns over the long haul, especially when you consider the power of compounding. That's why Bogle emphasizes the importance of choosing low cost investment options like index funds to maximize your net gains. It's all about keeping more of your hard earned money in your pocket and letting it grow unimpeded by those pesky fees and expenses. Remember, every dollar you save on fees is a dollar that can be invested and potentially grow over time thanks to the magic of compounding. So don't underestimate the impact of fees. They might seem small in the short term, but over the long run, they can make a world of difference. Speaking of long term thinking, let's delve into Bogle's seventh rule, which challenges a common misconception about risk. There's no escaping risk. Now, you might be thinking, wait a minute, aren't some investments considered safe? And you'd be right. There are investments that are generally considered lower risk, like bank CDs or government bonds. But what Bogle points out is that even these seemingly safe investments carry their own kind of risk. He's talking about inflation risk. Inflation, as you know, is the gradual increase in the price of goods and services over time. It's the silent thief that erodes the purchasing power of your money. Even if your money is sitting safely in a bank CD, earning a small amount of interest, if the rate of inflation is higher than that interest rate, your money is actually losing value in real terms. Think about it this way: if a loaf of bread costs $2 today and the inflation rate is 3%, that same loaf of bread will cost $2.06 next year. If your money is only earning 2% interest, you're actually losing ground. Your money is growing, but it's not keeping pace with the rising cost of goods and services. So, what's the takeaway here? Understanding and managing risk is a crucial part of investing. There are different types of risk, and it's important to be aware of how they can impact your portfolio. Don't assume that just because an investment is considered safe, it's completely risk free. There's always some level of risk involved, and it's up to you to assess that risk and make informed decisions that align with your goals and risk tolerance. Now let's move on to Bogle's eighth rule, which cautions against letting the past dictate your future investment decisions. Beware of fighting the last war. What he means by this is that you shouldn't make investment decisions based solely on past trends. The market and economic conditions are constantly changing, and what worked in the past might not work in the future. Let's look at a real world example to illustrate this point. Back in the 1970s, the United States experienced a period of high inflation, sometimes reaching double digits. Investors were understandably concerned about preserving their purchasing power, and many flocked to gold as a hedge against inflation. Gold, after all, was seen as a safe haven asset that would hold its value in times of economic turmoil. And for a while it worked. Gold prices soared, and those who had invested in gold saw their portfolios grow significantly. But then something interesting happened. Inflation started to cool down, thanks in part to the policies implemented by the Federal Reserve. And as inflation subsided, the price of gold began to decline. Those who had piled into gold, assuming that the trend of high inflation would continue indefinitely, ended up losing money. The lesson here is that you can't simply extrapolate past trends in the future. The world is constantly changing, and the factors that drive market performance are always in flux. What worked in the past might not work in the future, and clinging to outdated strategies can be a recipe for disaster. So, what should you do instead? Stay informed about current market conditions and be prepared to adapt your investment strategy accordingly. Don't be afraid to challenge your assumptions and adjust your approach as needed. The financial landscape is constantly evolving, so you need to be flexible and willing to change with the times. Now, let's explore Bogle's ninth rule, which offers a fascinating analogy to illustrate the difference between passive and active investing. The hedgehog beats the fox. This analogy comes from an ancient Greek parable about a cunning fox and a simple hedgehog. The fox, known for its intelligence and cleverness, devises many strategies to catch the hedgehog. The hedgehog, on the other hand, has only one defense mechanism, curling up into a spiky ball. And guess what? The hedgehog always wins. No matter how many clever tricks the fox tries, the hedgehog's simple defense proves to be the most effective. Bogle uses this parable to highlight the difference between passive and active investing. The hedgehog, in this case, represents the passive index investor. This investor knows one big thing: owning the market is the most effective strategy. They simply buy and hold a diversified portfolio that tracks the overall market without trying to outsmart the system or pick individual winners. The fox, on the other hand, represents the active investor. This investor knows many things, or at least they think they do. They try to outsmart the market, picking individual stocks or timing the market, believing they can beat the averages. However, as Bogle points out more often than not, the fox ends up underperforming the hedgehog. The constant effort to find the next hot stock or time the market perfectly often leads to higher costs and lower returns compared to simply owning the market through a low cost index fund. So, what's the moral of the story? Simplicity and discipline often trump complexity and cleverness, especially in the world of investing. Don't underestimate the power of a simple, straightforward approach. Sometimes the best strategy is the one that's the easiest to stick with, and that's what passive index investing is all about. Now let's move on to Bogle's 10th and final rule, which in many ways is the most important of all: stay the course. This rule emphasizes the importance of patience, discipline, and long term thinking. Once you've developed a sound investment plan that aligns with your goals, risk tolerance, and time horizon, stick with it. Don't let the inevitable ups and downs of the market derail your strategy. Remember, time is your friend, and the longer you stay invested, the more likely you are to achieve your financial goals. One of the biggest mistakes investors make is letting their emotions get the best of them. They panic when the market drops, selling their investments at a loss, or they get greedy when the market is soaring, buying high, and potentially setting themselves up for a fall. Bogle urges us to resist these temptations. Instead of reacting emotionally to market fluctuations, focus on the long game. Remember why you invested in the first place, and trust that your plan will eventually work if you give it enough time. Think of it like planting a tree. You don't expect to see fruit overnight. You have to nurture that tree, water, and fertilize it and be patient. Eventually, if you've cared for it properly, it will bear fruit. Investing is similar. You have to plant the seeds, tend to your investments, and be patient. Don't expect instant gratification. Focus on the long term and let the power of compounding work its magic. Now, I know this might sound a bit boring or even counterintuitive. In today's fast paced world, we're constantly bombarded with messages about instant gratification and quick fixes. But when it comes to investing, slow and steady wins the race. Those who can resist the urge to tinker with their portfolios, to chase the next hot stock, or to time the market are the ones who are most likely to succeed in the long run. So take a deep breath, trust the process, and remember time is on your side. If you can stay the course, you'll be amazed at what you can achieve. One of the things that really struck me as I was revisiting Bogle's rules is how much emphasis he places on the psychological aspects of investing. It's not just about numbers and charts, it's about understanding our own biases and tendencies and learning how to control those impulses that can lead us astray. He actually has a whole rule dedicated to this idea of emotional discipline, and it's one of my favorites. He calls it don't peek. Think about it like this: you're baking a cake. You wouldn't keep opening the oven door every few minutes to check on it, right? You trust the recipe, set the timer, and let the cake bake undisturbed until it's ready. Well, investing is kind of like that. Constantly checking your portfolio, especially during times of market volatility, can be incredibly tempting. But it can also lead you to make rash decisions based on those short term fluctuations. You see those numbers going down, and panic sets in. You might be tempted to sell everything, lock in those losses, and just get out of the market altogether. But that's often the worst thing you can do. Remember what we talked about earlier: time is your friend. The longer you stay invested, the more opportunity you have to ride out those market storms and come out stronger on the other side. Bogle even suggests, and I love this, just tossing those quarterly statements in the wastebasket. Out of sight, out of mind. Let your investments do their work without the constant worry and second guessing. Another brilliant financial mind, Jeremy Siegel, put it perfectly when he said, "The more often you look, the worse it is." And it really is that simple. Checking your portfolio constantly doesn't actually give you more control. It just amplifies your anxiety and increases the likelihood that you'll make an impulsive decision that you'll later regret. So trust the process, stay disciplined, and don't peek. Now, I know what some of you might be thinking, but what about risk? How can I be sure my investments are safe, especially with all this talk about market volatility? Well, Bogle addresses this head on, and he offers some pretty insightful perspectives. He actually argues that trying to avoid risk altogether is a risk in itself, especially in today's economic environment. You see, in our quest for safety, we often gravitate towards investments that are perceived as low risk, like bonds, or even just keeping our money in cash. But those seemingly safe options can actually be quite risky in the long run, especially when you consider the erosive power of inflation. Remember what we discussed about inflation? It's that silent thief that gradually steals the value of your money over time. And if your investments aren't growing at a rate that at least keeps pace with inflation, you're actually losing purchasing power, even if those numbers on your statements look stable. Bogle points out that while stocks are generally considered more volatile than bonds, they also have a much greater potential for growth over the long term. And that growth is what you need to outpace inflation and build real wealth. Of course, he's not suggesting that you go all in on stocks and just hope for the best. He still emphasizes the importance of a balanced portfolio, one that includes a mix of stocks and bonds to help mitigate risk and ensure that you're well positioned for whatever the market throws your way. But he does challenge the conventional wisdom that bonds are always the safe haven, especially in today's environment of historically low interest rates. In fact, he suggests that in this current climate, short term, high quality bond funds might be a better option than traditional long term bonds, or even those money market funds that many people see as the epitome of safety but are currently offering yields that barely keep up with inflation. What I find so brilliant about Bogle's approach is that he forces us to really think critically about our assumptions about risk and return. He encourages us to look beyond those simplistic labels of safe and risky and to really understand the nuances of different asset classes and how they can work together in a portfolio to help us achieve our financial goals. And that's what I hope you'll take away from our exploration of John Bogle's investment wisdom. In a world of flashy financial products and endless market noise, his 10 rules stand as a beacon of simplicity and common sense. They remind us that investing doesn't have to be a game of chance, the roller coaster ride of emotions, or constant battle against those who would seek to profit from our fear and uncertainty. It can be, and it should be, a journey of empowerment, a process of building a solid foundation for our financial futures, brick by brick, dollar by dollar, year by year. So take a deep breath, trust the process, and remember, time is on your side, as Bogle himself often said. The greatest enemy of a good plan is the constant tinkering with it. Once you've done the work, once you've educated yourself, once you've built a portfolio that aligns with your goals and your values, let it be. Let it grow. Let the magic of compounding work its wonders. And most importantly, don't let anyone tell you that you can't do it. Don't let anyone convince you that investing is only for the wealthy, the privileged, or the experts. John Bogle proved that anyone, regardless of their background or their income, can become a successful investor. All it takes is a little knowledge, a lot of discipline, and a belief in the power of long term thinking. We hope you enjoyed this look at the wisdom of John Bogle. We encourage you to check out other videos on our channel, Speaks Finance, where we explore a wide range of financial topics from investing strategies to personal finance tips to interviews with some of the brightest minds in the industry. And don't forget to like, comment, and subscribe to stay updated on our latest content. Thanks for joining us on this journey.